Have you ever heard the term kicking the can down the road? That's exactly what the Japanese economy has been doing, and that's exactly what the US economy has been doing, in different ways, of course, and Japan has been doing it on a much grander scale, and we'll break into that here in this video. But I want to symbolize exactly what has been happening over the past 40 years in Japan to show you guys why the stock market in Japan crashed this week and why I think that it could be a sign of more things to come. Today, the markets are rebounding, or that's what they're showing, but this could be a large, gigantic bull trap that is going to trap a lot of people inside the market while the wealthy just get even wealthier. Let's break into it. According to Investopedia, a bull trap is a false signal referring to a declining trend in a stock index or other security that reverses after a convincing rally and breaks a prior support level. The move traps traders or investors that acted on the buy signal and generate losses on resulting long positions. A bull trap may also refer to a whipsaw pattern. And if you scroll down on Investopedia, you'll see exactly what a bull trap looks like. Here's a great example. This is what the S&P 500 looks like today. Very similar, right? This is what Bitcoin looks like today. Very similar in pattern, right? The first thing that I want to show you guys today is a tweet that I found explaining exactly what happened to the Japanese stock market. The tweet says the sharp rise in the Japanese yen and US dollar is causing a massive unwind of yen carry trade positions and contributing to the sharp decline in US stocks. For those who do not understand how this works, a brief explanation. 1. Many traders were borrowing Japanese yen at low interest rates, converted them to US dollars, and used this to buy US stocks. 2. Now that the Bank of Japan is raising interest rates, the Japanese yen has strengthened significantly against the US dollar, meaning that the Japanese yen has gone up in comparison to the price of the US dollar. Now these traders are in big doo-doo. Not only must they pay higher interest for the Japanese yen they borrowed, they're now facing huge forex losses as well. The US dollar assets they're holding may not be enough to repay the Japanese yen they've borrowed. 3. This is causing a huge unwind of these trade positions. Traders facing big losses and margin calls are selling their US stocks to raise US dollars, converting back to the Japanese yen and paying back their loans. This can lead to more selling pressure on US stocks and even more declines in the short term. Middle East war escalation, US political uncertainty is also adding to the fear and panic, along with the jobs report that we received this past week, along with the FOMC not raising interest rates last week. As an investor, this is great news because this type of short-term crisis and panic is what gives me the opportunity to scoop up high-quality US stocks at bigger and bigger discounts. Take advantage of temporary mispricing caused by short-term crisis. Okay, that is just one person's opinion, right? It explains why the stock market crashed because all of these people took out loans in yen that had very low interest rates or even negative interest rates, purchased US stocks with US dollars. So basically they converted from Japanese yen to the US dollar and purchased US stocks using those US dollars that were converted from the Japanese yen that were taken out in loans using these very incredibly low interest rates. But then the Japanese government decided to raise interest rates unexpectedly. And all of these people that had these loans got margin called and were forced to liquidate. There's rumors that there was one giant whale out there that liquidated a lot of their holdings within a span of just 12 days, and that caused a cascading effect in the market. But if we are to believe that that's true, that is a very frightening thing to consider, that one person or one entity could have so much damage in the market. Just think if somebody like Elon Musk or George Soros or Bill Gates were to liquidate a lot of their holdings, what kind of cascading effect would that have on the market? The next thing that I want to show you guys is a tweet from Richard Todero on Twitter that actually took place 2 years ago, explaining exactly what's happening in the Japanese market. Japan, the third largest economy on the planet, is a Ponzi scheme. If it was a person, they would make $54,000 a year, spending $94,000 a year, 65% more, with $1.3 million in debt. A 1% increase in rates would increase their expenses by $13,000 or 23% of their income to $108,000 a year, or 100% more than their income. Japan is spending 66% more than they're taxing its citizens. Japan's debt is $12.8 trillion. This was back in 22, mind you, so those numbers have actually gone up since then. In order to balance their budget with a 1% increase in rates, they would have to raise taxes by 100% on their citizens. But here's the kicker. Citizens' tax rate in Japan is at 40% and companies are at 32%. Now, that is just a rough estimation because there are tax brackets just like there are here in the United States, but that kind of gives you a picture of what their taxes look like there in Japan. So they don't have a lot of room to raise taxes to fix the problem. Japan's deficit is 65% higher than their taxes. If a company were to operate under these same standards, they would not be in business within their first year of operation. And yet, these economies, like Japan, continue to operate like nothing is happening, just kicking the can down the road. Somebody asked them to then do the USA, and here was his response. US debt to GDP is about 125 versus Japan at 225. So they're about 15 years ahead of the Ponzi scheme, but the US is not pretty either. Government budget. We plan to spend 28% more, or $1.6 trillion more per year than we're taxing our citizens over the next 10 years. This will add $15 trillion to our debt, making it $47 trillion. This assumes 4% GDP growth per year, no recessions, no wars, and a small tax increase in 2026. Now, this was written, like I said, in 2022, and we can definitely for sure say that some of these things have already come to fruition. There are wars. There is a looming recession. There has not been any talks of tax increases. And that's one thing that I kind of disagree with in his logic. I don't think that we need to raise taxes here in the US. I think that we need to drastically lower our spending as a nation. We like to use these numbers of spending in the government for GDP, and I don't think that that's right. I think that those numbers should be completely separated from the equation because at the end of the day, the US government does not create or build anything. Companies in this free market do. The government is only run by the taxes that it collects. And if we continue to spend at a much higher rate than the taxes that we collect, there's a problem there. But if we raise taxes, then it stifles innovation, it stifles business growth, it stifles people going to the market and spending more money. The middle class is already dwindling in the United States, and that would only make it dwindle even further. Studies show that 70% of our economy is made up of everyday average consumers. So if more of their bankroll is being paid into taxes, they have less money to spend in the economy. And it becomes this vicious cycle. But I want to know what your thoughts are. Are these thoughts just completely insane? What do you think would solve this issue? How do we get our spending down? How do we get our debt down? And what is your outlook on the economy over the next 10 years? Let me know in the comments. That's going to be it for today's video. Thank you so much for watching. Crypto Clay, out.